Alright, so today's bank is Community Trust Bancorp. They're located in Pikeville, Kentucky. And they've got around, I don't know, 79, 80 or so branches, and they're in Kentucky, West Virginia, Tennessee. So kind of isolated to that geographic area. But maybe a moderate-sized bank, pretty much in the middle of the range that we normally see as far as size goes. And looking at their Yahoo Finance page, we can see that they've had a really good run up over the past year. As we've seen, most banks kind of have a little up right here and then another little up right here, and then they sort of decide whether they're going to go up or down, or up or across at this point. So this bank ended up going up, so it must have had some good prospects. So if we scroll down a little bit, we can see that they've got 750 million market cap. So yeah, that's pretty average. PE ratio of 9.69. That's a pretty good ratio. So that's about a 10.3% earnings yield, which is it's pretty average. Pretty much right in the middle of most of the banks in our the range of where most of our banks fall as far as earnings yield. So pretty average priced bank, it seems like. And so if we go to the statistics, we can also see the price to book, which is 1.07. It's pretty average as well. We'll typically see, I believe, something like 0.85 to 1.05. Of course, this is dependent on whether they have available for sale securities or held to maturity securities on their balance sheet, which we'll dig into that as well and see how does that ratio look from that standpoint. But if we go down to some of the profitability measures, we can see 1.36% return on assets, which is fantastic. We typically see something like 0.8 to 1.05%, so 1.36% return on assets is it's a really good return, and so is the return on equity. So perhaps it's a pretty good profitable bank, and from the price to book and PE ratios, maybe it's trading at a reasonable price also. So we might have a good prospect here. So let's start digging in and see if that's the case. So getting into the balance sheet, we've got almost 300 million of cash here. It's about 5% of the assets, so that's really very, very average. It's right in the middle of the range that most banks have cash on their balance sheet. As far as the securities go, they're all available for sale, so they're all at fair value. It's a little over 1.1 billion. That represents about 19% of assets. That's pretty average as well. Maybe a little bit on the high side. As far as the loans go, about 4.1 billion, a little bit more. That's 71%. That's about average as well. So, goodwill 65. That's 1%. That's pretty average. This is a very, very average asset side of the balance sheet. So from that, we might expect pretty average net interest income. And we'll see when we get to the income statement. But yeah, I mean, it's almost everything's right in the middle of what an average normal bank right now, how its balance sheet would be structured. So interesting. And then we have on the liability side, we've got some non-interest bearing of almost 1.3 billion, and that works out to about 25%. That's a little bit on the high end, which is great. We would prefer to have as much, zero cost funding as we can. We've got 3.5 billion of yielding deposits. That's pretty average, and then not too much debt either. So they've got a little bit more repurchase agreements than we would typically see, but the debt is only about 65 million, which is almost nothing. So they almost have no debt. It's about 1% of the liabilities. So Yeah, so it seems like from a liability side, they might have a little bit cheaper interest expense just because they've got a little more allocation toward non-interest bearing deposits, and none of the higher cost funding sources like the debts. I guess it depends on the allocation of the interest bearing accounts and what the yields are on them, but as it seems like we might have like a very average interest income, but maybe like a little bit better interest expense just based on this, so we can look at the income statement and see if that's the case. So we've got interest income here of about 75 million, and that's about 5.44%, and that's a pretty average amount that's right around what we've been seeing for this quarter, so that's pretty good. And the loans coming in at 6.22%, that's fantastic. And the securities are dragging them down a little bit. It's about 2.5%, which might be a little bit on the low end for right now, but as it is, 75 million on the assets that they have in place, it's pretty average interest income, which is what we would have expected based on them having an average balance sheet structure. Looking at the interest expense, we can see 31.4 million, and that's about 2.5%. So that's pretty average. So it seems like what we were talking about, maybe the less debt maybe didn't help them out a whole lot. But 2.5% right now is a very reasonable interest expense yield. So that's fantastic. All that comes together at about 43 million, which is about 2.98% net interest income margin on the assets in place. So and that's fantastic. That's about where we're looking for. We're looking for something around 3% or more. So they're making really good money on the net interest income. Basically, a very average amount of net interest income, and that's good. Because we've been seeing a lot of banks lately that aren't doing very well on the net interest income, so it's nice to see a bank that's doing well. And then non-interest income, 15 million. That's about 17% of the revenue, which is higher than we normally see. Typically see 10 to 13%. So 17%. They're also making good money on non-interest income, which is awesome. And it's because they've got some of the ancillary services, trust, wealth management, broker income, that sort of thing, which adds a little bit more income to the income statement. And that's good. And then so they've got non-interest expense of 32 million, and that is about 36% of revenue, which is on the low side as well. We typically see like 41 to 47%, something like that. So not only are they making pretty good net interest income, they have higher than average non-interest income and lower than average non-interest expense. So all those things together should result in a pretty good net income. After income taxes, we've got almost 19 million, and that represents a return on assets of 1.27%, which is fantastic. Like we noted earlier, we usually see something like 0.8 to 1.05, so they're making 1.27%, which is that's a really good return on the assets that they have. And but as far as pricing, so if we take the market cap of 755 million and compare it to this 18.5 million, we get an earnings yield of about 9.85%, which is it's an average. It's in the average range, but it's sort of in the lower half of the average. But it's actually almost right in the middle. So we usually see something between like 9 and 11% right now earnings yield, and so 9.85 is pretty close to right in the middle of the average. So this is a very average balance sheet bank, very average income statement bank, if not a little bit more profitable than the average bank, and the price on those earnings is very, very average. So this is yeah, that's interesting. So we can dive into a little bit of the risks and see whether its risks also fall within the normal averages. And if the risks turn out okay, it seems like this might be a good prospect to buy. I'm not looking for home runs. I'm looking for good base hits, right? And this would be a good base hit, good average bank at a good reasonable price, and we can dig into the risks and see if the risks end up a good average risks, and if that's the case, then we can pull the trigger on it. But let's see. So let's get on past the accounting policies. All right, so we've got the securities here. It looks like mostly mortgage-backed securities, as is typically the case, and they've got some munis, U.S. Treasuries. Yeah. So Treasuries and mortgage-backed securities, those two together comes to about 70% of the securities portfolio, and those are riskless, implied or explicit. And so then 30% could possibly have some risk, so the munis plus the asset-backed securities, and we'll be able to see a little bit more about what those are and why, or whether there should be some kind of allowance. Hopefully they discuss it a little bit in the footnotes. We can see that there's some unrealized losses here, which isn't that uncommon right now. All banks have unrealized losses on their security currently. And then we can see the term structure, the duration of the securities portfolio. We can get a better idea of how this is reflected in the interest rate risk of the bank once we get a little further, and we can see the repricing timing of the call reports. But it's helpful to see. It looks like 30% or so mature within the first 5 years, which is actually a lot faster than a lot of banks will have. So, and then they can't really place the timing for mortgage-backed securities, so they're kind of down here in their own category. But this might mean that it might reprice a little bit faster than the average bank on the securities than what we typically see. So that would be helpful in a rising rate environment, which is sort of where we are right now. So they don't really speak specifically about the the credit quality of the state and political subdivisions or asset-backed securities. But they do say that the unrealized losses of them are caused by interest rate changes and not necessarily credit problems. And so that perhaps that means that there's not an allowance against them, and perhaps that means that that's reasonable. So, maybe they touch on them a little bit more in the MD and A. But currently, 70% of the securities portfolio is riskless, and then, typically the banks don't buy super risky securities, and I would, like to think that that's the case here, but perhaps we'll learn a little bit more later on. So from the loan standpoint, which we saw the loans represent 74% of the assets, so it's a really important component of our analysis since it has such a material effect on the bank's earnings. So they've got a few of their higher allocated industries separated out here so we can see them a little bit easier. But when we lump these together, so sort of C&I loan, commercial, industrial, that gets about 20%. That's pretty average. That's right around in the range where most banks end up for their C&I, at least the ones in our population. Commercial real estate would be these two, 456 plus 813. It's about 30%, which is a little bit on the low end of what we would normally see, but not too far out. So what I think is sort of an unusual allocation for the bank is its consumer loans, which is almost $1 billion, and that's 23%, which is a lot higher than what we would normally see. We typically see 2 to 5% of the loan portfolio being some kind of consumer loans. So this bank's a little bit more allocated toward consumer loans, and typically when it's like indirect like this, typically means like auto loans. So maybe they explain it a little bit more down here. Yeah, so indirect loans, primarily fixed rate consumer loans secured by automobiles, trucks, so on and so forth. So I feel like those loans might have an outsized risk to them. But once we get into the non-accruals and classifieds and past dues, we could see how that looks. But that is a higher allocation than what we would typically see. And so going down to that section, you can see the allowance here, which totals almost 51 million. That's about 1.21% of loans, which is very average. It's right in the middle, or maybe even a little bit on the low or on the high side of the range we typically see for the allowance as a percentage of loans. So if we could see, if the loan portfolio ends up having an average risk, then it would make sense that they've got an average type of reserve here. So we'll see a little bit more as we kind of dig through. Yeah, so we can see consumer indirect 13.6 million. So they do have a higher amount reserved against the consumer indirect loans. So maybe our thought process that those are a little bit higher risk might be the case, and they've reserved a little bit more for those. So let's see what they have to say about it. We can see that they've got about 16 million of non-performing loans, which I think is pretty low. Yeah, and once you add in the Oreo, which they talk about elsewhere, it gets about 17 million, which is on the low end. So non-performing loans are pretty low. Non-accruals are pretty low as well. The only thing that's making the non-performing loans really come up is the 90 days plus and still accruing. So perhaps those need to be put into the non-accrual at this point. But yeah, so pretty low amount of non-performing loans currently. And we can see that there's not a lot in the consumer indirect, so that's good. It's mostly all coming from the consumer real estate mortgages, so interesting. And now we're at the past dues, so we can see about 27 million is past due, and that's about 0.64%. That's pretty average amount as well, pretty much in the middle of the average of what we would see for most banks, so not at all unusual to see that much past due. So now we're down into the, we can see credit quality indicators, which is classified loans. We typically, or at least for us, we like to look at the classified, which is substandard plus doubtful. And these are ones that, there's a well-defined weakness that makes it to where the loan's inadequately protected by its worth and paying capacity of their customer. And there's a threat that there's going to be a loss if the deficiencies aren't corrected. So there's almost kind of a forewarning in a way. So what we've been seeing a little bit with some of the other banks that we've looked at recently is that the past dues and non-accruals will be muted. They won't be bad at all. But then we'll get down into the credit quality indicators, and it'll show being above normal credit risk. So we'll see if that's the case here. Alright, so first we've got all the commercial loans, I believe. And so we can see the substandard, doubtful, and the totals coming to 48 plus 0.1, about 0.2 million. So commercial loans just about 48 million, and then we can come down to the more of the consumer loans and add a couple of these together. And when we do that, we've got about 58.7 million of classified loans, and that's about 1.41%. So that's right in the average for what most banks have right now as far as the classified loans. So, given that they have low past dues, low non-accruals, classified loans is pretty average. Even looking at this, there's not a whole lot of, the indirect automobile was what I was thinking would be the, higher risk part, but there's no classified loans for that, basically. Well, about 700,000. So all that to say, perhaps there's a pretty average credit risk here, and then also a pretty average reserve against that credit risk. So, that makes me feel good that perhaps they have an adequate reserve. Yeah, so pretty straightforward. TDRs are pretty low as well. So I feel pretty good about the credit risk. Got a little bit of Oreo currently, but not a whole lot. Alright, so we're getting into the repurchase agreements here, which they've got about 235 million, and they all reprice pretty quickly. So and they don't mention the rest of the debt here, but if you remember page 37. So on the balance sheet, there's another 65 million. Yeah. So part of it is 300,000 from the FHLB. It seems pretty crazy to have a $300,000 loan with the FHLB, but it is what it is. And then so about 64 million of long-term debt here, which is actually, I had to go back to the 10K to see what that is, but it's basically trust preferred securities, which is kind of what I guessed. But they carry floating rates for a long time. I think they mature 2037, 2038, which is typical for most banks have those in place that mature around that time and have floating rates. So so that's a risk from interest rate repricing risk. But, as it is on the balance sheet we see here, the repurchase agreements reprice really quickly, as do the trust preferred securities. They reprice, every time, like every quarter maybe. So basically all the debt on the balance sheet reprices very quickly. So in order to mitigate the interest rate risk from that, we would also need to have some assets that reprice fairly quickly, and we'll be able to explore that a little bit later. But I do remember that the securities seem to reprice a little quicker than most banks, so maybe that helps sort of offset some of the quick repricing on this liability side. Anyway, so now we're going into the fair value measurements, and we can compare the carrying amount of the assets and liabilities on the balance sheet. Can compare it to the fair values, and since we've got the securities are just available for sale, so there's no adjustments to be made there, right? Because they're carried at fair value on the balance sheet. The loans usually have a difference, and it looks like it's maybe about 300 million. Yeah, 279 million, and that would make the equity be reduced by about 40%. So if we, when we adjust things to fair value, it reduces the equity value by about 40%, which is a little bit on the higher side, but not that unusual either. I think what is unusual, the deposits. So there's a $420 million difference in the deposit value as well. So 4.3 million minus 4.8 million. So we typically don't see such a high difference on the deposit side, and that's because they usually reprice really quickly, right? Only thing that you might could claim would be different would be like the time deposits, and so it's interesting that there would be such a big difference. There's only maybe like 3 or 4 banks that have such a big difference between carrying value and fair value of in their deposits, and I'm not quite sure whether there's something different about those banks and whether that's actually a good measure of their fair value. I mean, it says level 1 and level 2 inputs, but sometimes I'm a little bit cautious or suspicious of that, because if you reduce the fair value of the liabilities, that increases the value of your equity, right? So, and such a big amount increases the value of the equity by like 61% or something. So, and that's very, very unusual for a bank. So I don't know if there's the people that helped them make this valuation did it differently than all the other banks, or if there's something unique about the deposits that make its value be so much less. I don't know the answer to that. Maybe someone can help me. But I always sort of look at this, making a thought process for like, okay, what if that is wrong and that the deposits should be about the same fair value as carrying amount? How does that put things, right? So anyway, if we look at by including this deposit adjustment, it puts the price to tangible fair value of its equity at about 0.95 times. So you basically, at this market price, stock price, you would be buying the net assets of the bank at fair value for less than what the stock price is. And so, for such a good profitability and potentially good risks bank, it seems like that would make sense that it would be below, or the fair value of the net assets would be below its market cap, right? I could see that if the bank was really risky or it wasn't making any money, something like that. But this is a really good, well-run bank, so I can't. It doesn't make sense that the deposits would, the price to fair value would be so low, and that's because these deposits have such a big change in from carrying amount to fair value. So if we were to exclude the deposits fair value adjustment, it puts the pricing of the bank at about 2 times tangible fair value of its net assets. So, and that's very, very in the middle of the range that we would see for most banks. So 1.5 to 2.5 is usually the multiple that we see on this. So that makes me think that, probably we should not use the fair values that they've put here in our calculations, and we should just make it be that the carrying amount is about the same as the fair value. But if it turns out that these are truly accurate, then that means we're buying the bank for even cheaper. Anyway, I'm just kind of taking a conservative approach here, and even then, excluding this fair value adjustment for the deposits, the net asset value divided by its assets, so basically a common equity ratio, but at fair values, is about 6.86%, which is above the range that we typically see. So, that would tell us that even at fair values, the bank is well capitalized compared to other banks. Its net assets are values are high enough to support the assets on its balance sheet better than other banks are. So anyway, so it seems like it's a well capitalized bank, but it's also at its net assets are at a fair price. Just kind of looking at these things in a vacuum. But even looking at 2023, there's not really a significant difference in the fair value. So 1.26 plus 3.48, that's about 4.7, which is the same as its carrying amount. So either something's different or unique about this year in their deposits, or this year they've made an error in their fair value calculations. So I'm not sure which, but we're going to take a conservative approach on that. And either way, it puts us where it's a pretty fair price for the bank, I feel like. All right, so now we're down in the MD and A. We can see that they've got, so 80 banking locations, and they're in Kentucky, West Virginia, and Tennessee. And so coming down here, we can see some of the yields here. So the yield on their assets, the yield on their liabilities. Unfortunately, they don't provide a granular calculation that we're used to seeing, where it splits up loans, securities, and then on the liability side, the deposits and time deposits and debt, etc. So we just kind of got to look at this as a whole and really can't dig into the granular side of it. But net interest income 3.23%. That's fantastic. And the 5.5 is pretty average. Interest-bearing liabilities 3.35. That's pretty average. But as we saw, the bank has a little bit more non-interest-bearing deposits than what we would typically see. So that brings up this net interest margin. So really great profitability bank. And then we talk a little bit about some of the areas that we've already gone through as we went through the footnote. Yeah, and I read through the asset quality here, so nothing really interesting to note. Now we can come into the liquidity risk. Unfortunately, this bank doesn't provide as detailed or granular information about some of the topics that we usually dive a little deeper into, so we sort of have to make our own calculations and assumptions in a lot of ways, but we'll do our best. So we've got about $294 million of cash, and so as we talked about, it's a pretty average amount, as the most banks do, and about 85% of their securities are pledged, so that leaves about 161 million unencumbered securities. And so on balance sheet liquidity is probably about 450 million, 500 million, something like that, which is about 9.5% of deposits, and that's a little bit on the low side. Typically we see something like 12 to 18%, something like that. So they got almost 10% on balance sheet liquidity. But if we take into account what they can borrow from FHLB, which looks like about a little over 550 million. So and then they've also got 50 million that they can borrow from a correspondent bank. So yeah, 50 million right here. And they've also got about $1 billion of unencumbered loans, so only about 25% of their loans are pledged. So they've got about, once you add the on-balance sheet liquidity, which was cash, and the unencumbered securities, then you can add, the borrowings that they can make from FHLB and correspondent banks. and all that comes together at about $3.5 billion. Also, when you take into account the unencumbered loans, which isn't a typical thing to add to this, but realistically, they could pledge the loans to the FHLB or someone, but it's limited to a certain percentage of their assets, so it could be capped. But if they add the unencumbered loans to the pledged securities, and that gets them $3.5 billion, which is about 72% of deposits, which is within an average range. It's on the lower side of the range, but it's not within the range. Which so I would say they've got enough, or they've got liquidity, an average amount of liquidity that most banks currently do right now. And that amount as a percentage of uninsured deposits is 265%, which is a good average as well. Pretty much right in the middle of the range of what we would normally see. So even as a percentage of commitments, it's about 350%. So right in the average for where most banks are positioned. So I feel like their liquidity and the capital is probably appropriate, or it's at least how an average bank is structured currently. They have a lot more securities or a higher allocation to securities than some banks do, which is great for the liquidity. Also, an average amount of cash. And so comparing these things to the amount of deposits or amount of assets or anything like that puts them shows that they're in a pretty good place. And so as far as the interest rate risk goes, we usually have a chart here or a table that shows how much would the net interest income go up or down depending on which way the market interest rates go, and they don't have that here, unfortunately. They probably got it in the 10K, but so we sort of do our own calculation to do that, and doing so puts them in line with where an average bank's repricing of assets and liabilities is. It's sort of, I would say it's more on a little bit more liability sensitive than I typically like to see, but it's about where an average bank's is. So for a little bit more detail on that, the securities, of course, as is the case for, actually they mature a little bit faster or they reprice a little bit faster than what most banks do. Probably about 45% reprice within the next 5 years, 18% within the next year, and those are both above what we would see for most banks. So the securities reprice at a more favorable timing than what most banks do. And then as far as the loans go, it's a pretty average amount repriced within the next year. But within years 1 through 5, we see 50% of the loan portfolio repricing. So that's a really high amount. So as far as when we're looking at this, we're looking at what's our risk over the next year, right? So as it shows here, the asset side of the balance sheet is a pretty average risk over the next year. Years 1 to 5 is probably a little bit more asset sensitive. But anyway, so looking at the liability side, 27% of the deposits are non-interest bearing, so they don't reprice at all, right? So those are basically riskless to us unless they were to migrate to interest bearing accounts. But basically, if we were to add together the interest-bearing deposits like the savings and money market accounts and stuff like that to the time deposits that mature within the next year, That puts us about 71% of the liability side, or 71% of the deposits, which is a very average amount as well. And then if you remember, all the debt essentially reprices within the next year. So that's a little bit higher than normal. So, all that to say, combining the asset side and the liability side repricings puts us at a very average repricing timing, repricing risk. And so, it seems like our change in net interest income would change in line with that of the average bank. So, our bank is sitting at an average interest rate risk. And then as far as capital resources go, they use the CBLR, which they've got to have, I think, at least 9%. It's similar to the leverage ratio, I believe. And in this case, they've got 13.74% for the corporation, and that's just really, really high, which is a good thing. Most banks, it's somewhere between 9.5–10% for the leverage ratio. So these guys having 13.74% is really, really strong capital position. Of course, it's not risk adjusted. It's based on the average assets. So, but even then, it's a very good, strong ratio. And if you look at the common equity ratio, it's about 12.10%, which is basically the common equity divided by the assets. So that's a very strong ratio as well. We typically see 9 to 10.5%. So they're being at 12%. That's fantastic as well. We saw also that whenever we convert everything to fair value, the tangible fair value of its equity also has a lot higher ratio than most banks when compared to its assets. So, in conjunction with the liquidity we talked about, where it seemed like they had, adequate average liquidity, I can't see any flaws with the capital. It seems like they're well capitalized, at least capitalized in line with that of the average bank, if not better. So anyway, so I feel like they've got a good capital liquidity position. And I think that is at the bottom of the thing, yes. All right, so let's recap what we talked about and what our decision is. So basically, it's a really good, profitable bank. So they were earning about 1.27% return on assets, which is it's a fantastically high return on assets. So doing really good, and that was partly because of really good net interest income, and that's partly because a lot of their interest-bearing deposits are non-interest-bearing. Or a lot of their deposits are non-interest-bearing, and so they also had really good non-interest income because they had a lot of ancillary services like wealth management, trust, broker commissions, that type of thing, and then also a lower non-interest expense than the average bank. So all that together makes them a really good, profitable bank. And then when you compare it to the bank's market price, it came in at about 9.85%, which is kind of right in the middle of what we would see for most banks. You were seeing somewhere between 9 and 11, so somewhere around 10%, so like very average priced relative to those earnings. So anyway, I feel like the profitability earnings of the bank are really good, and they're well priced. Considering the risks from a credit risk standpoint, we saw that they've got pretty low past dues. They've got pretty low non-accruals. They did have the classified loans were pretty average. They were in the average range of what we would normally see, and so they also had a very average reserve. So I think the reserve was a little over 1.2% of loans. So given that they've got low past dues, low non-accruals, and pretty average classified loans. I feel like, having an average reserve makes sense, and the reserve was actually a little bit on the high end, so maybe a little bit, it's within the normal average range, but a little bit on the high side. So I feel like they're really well reserved for credit losses. Not to say that, they could be dinged later on, but not to say that they might not be dinged later on, but when we're comparing it to the average bank, then they've got a good average reserve to mitigate any potential loan losses that are apparent in the books currently, in the loan portfolio currently. So I feel like really good average credit risk. We saw the capital liquidity risk is pretty average as well. From a capital standpoint, they've got exceptional fair value of its equity, the assets minus liabilities, and which provides better coverage of the assets than what the average bank has. They also had exceptional regulatory ratios, which also had an exceptional common equity ratio. And as far as the liquidity goes, they had about an average amount of cash. They had more securities than the typical bank has. Pretty average asset side of the balance sheet as well. When we add in the on-balance sheet liquidity and the off-balance sheet liquidity, they've got a pretty average amount as well. And, I didn't mention it before, but they also have a pretty low amount of uninsured deposits. So I think 27% or so, which is a very low percentage compared to what most banks have. So all that to say, they also don't have any brokered deposits. So as far as the capital and the use of funds and the sources of funds, I think they're really well capitalized. Interest rate risk, we talked about, they are pretty much just average of where most banks are right now. I feel like the average is a little bit more liability sensitive. I prefer to be a little bit more asset sensitive, but we're within the range of where an average bank is as far as the repricing of its assets and liabilities. And so, whichever way interest rates end up going, our bank's net interest income is going to, either squeeze or expand in unison, more likely closely with that of the average bank out there. So that puts our interest rate risk when compared to other banks as being pretty neutral, right? So all that to say, I feel like we have a pretty average profitability bank with a pretty average market price on those earnings, but also pretty average risks across the board. And even if we were to consider the market price compared to the tangible fair value of its net assets, that becomes even an average price either. It was 2 times net asset value. So all that to say, I feel like we have a really good average bank at a really good average price. I don't think that it's a home run or one that's going to be a 10 bagger or something, but I think that it's a very fair price and a really well-run bank, and certainly be a good addition to anyone's portfolio. So anyway, that is my analysis and conclusion on the thing. Definitely let me know what you think in the comments if there's anything that you would like to add or clarify. Certainly make a comment about it. Love to hear what you have to think, or love to hear what you have to say. And so, yeah, thank you for listening.